In 1985, five governments met in secret at a New York hotel and made a decision that destroyed the world's second largest economy for 30 years. That same decision, using almost identical logic, almost identical tools, and an almost identical justification, is being openly designed right now by the most powerful economic administration on Earth. The country that pays the price this time may not be Japan. Before we go any further, an important disclosure. Nothing in this video constitutes financial, investment, or legal advice. Everything presented here is analytical and historical commentary, drawing on publicly available economic research, policy documents, and market data. Every individual's financial circumstances are different. Please consult a qualified financial professional before making any investment or financial decisions. With that clearly stated, let's get into one of the most important and least understood stories in modern economic history. There is a certain kind of macro analyst, the kind who has spent decades studying how power actually moves through financial systems rather than how textbooks say it should, who looks at the current dollar and trade situation and immediately reaches for one specific historical reference. Not 2008, not the dot-com crash, not even Bretton Woods. They reach for the Plaza Accord of 1985. Because what happened in that hotel room in New York 40 years ago, and what it did to Japan in the decades that followed, is not merely an interesting historical parallel to what is being engineered today. It is the precise template, and the people designing today's version are referencing it by name. Let's build this properly from the ground up, because the history matters enormously for understanding what is at stake right now. September 22, 1985. The finance ministers and central bank governors of five nations gathered quietly at the Plaza Hotel in New York City. The United States, Japan, West Germany, France, and the United Kingdom. There were no press conferences beforehand, no public debate, no congressional vote, just five officials in a room, signing an agreement that would reshape the global economy for the next 4 decades. That agreement is known as the Plaza Accord. If you have never heard of it, that is precisely the problem, because what it did to Japan is the most detailed and documented warning that economic history has ever produced about currency manipulation at scale, and that warning is being ignored in almost every mainstream analysis of the current moment. To understand why that meeting happened, you need to understand what the US dollar had been doing in the 5 years leading up to it. Between 1980 and 1985, the dollar had appreciated by roughly 50% against the currencies of the world's other major economies. The Japanese yen, the West German Deutsche Mark, the French franc, and the British pound had all weakened dramatically against the dollar over that period. In March 1985, the dollar hit its highest valuation against the British pound in recorded history, a level that would not be surpassed for over 30 years. The dollar index, which measures the dollar's value against a basket of major currencies, had reached approximately 160. For context, it trades around 103 today. By any historical measure, the dollar was significantly, structurally overvalued. This sounds like a good thing for America on the surface. A strong dollar increases purchasing power. Imports become cheaper. Consumers benefit. But the structural problem that a persistently overvalued currency creates for a manufacturing and export economy is one that almost no mainstream commentary explains with sufficient clarity, and it is worth taking the time to understand the mechanism properly. When your currency is significantly stronger than those of your major trading partners, your exports become expensive in global markets. A Japanese consumer looking to purchase an American product has to convert yen into dollars first. The stronger the dollar, the more yen that conversion costs, and the more expensive the American product becomes relative to a domestic Japanese alternative. Simultaneously, imports into the United States become cheap for American consumers. So cheap that American manufacturers find themselves being undercut on price across industry after industry. Not because foreign companies are more efficient or more innovative, but simply because the currency arithmetic makes their products artificially inexpensive in dollar terms. By 1984, the United States was running a current account deficit of over $100 billion. American manufacturers, farmers, heavy industrialists, and technology companies were lobbying Congress with increasing urgency. IBM was complaining. Caterpillar was complaining. The entire American agricultural export sector was complaining. The message from all of them was the same. The strong dollar is making it impossible for us to compete. Congress began seriously debating protectionist trade legislation that would have triggered a global trade war. Faced with that prospect, the Reagan administration made a strategic decision: address the problem not through tariffs, but through currency. The Plaza Accord was the instrument. The agreement was straightforward in design. The five signatory nations agreed to coordinate intervention in foreign exchange markets to deliberately weaken the U.S. dollar. Their central banks would sell dollars and buy other currencies, particularly the Japanese yen and the West German Deutsche Mark, in order to push the dollar's value down and restore competitiveness to American exports. The stated objective was to reduce the U.S. trade deficit. The actual mechanism was direct, coordinated currency market manipulation by the most powerful governments on Earth acting in concert. And for the United States, it worked. In the 2 years following the Plaza Accord, the dollar fell sharply. American exports became cheaper in global markets. The trade deficit began to narrow. American manufacturers got the competitive relief they had been demanding. By the early 1990s, the United States had actually returned to a current account surplus. From the American perspective, the Plaza Accord was a textbook example of successful coordinated policy intervention correcting a dangerous global imbalance. But here is the part of the story that gets systematically omitted from every American telling of it. For Japan, the Plaza Accord was the beginning of a 30-year catastrophe from which the country has still not fully recovered. In 1985, the Japanese yen traded at roughly 240 yen to the dollar. By 1988, just 3 years later, it had strengthened to approximately 120 yen to the dollar. The yen had doubled in value in less than 3 years. To understand what that means for an economy like Japan's, you need to understand what the Japanese economy was built on. Japan had spent the 3 decades following World War II constructing the most formidable export manufacturing machine in the world. Sony, Toyota, Honda, Panasonic, Canon. The entire Japanese economic miracle was built on one foundational premise: manufacture goods with extraordinary efficiency and sell them to the world at prices that competitors could not match. A competitive yen had been the bedrock of that model for a generation. Japanese goods were priced attractively in international markets because the currency math made them cheap for foreign buyers. When the yen doubled in value in roughly 3 years, that foundation cracked without warning. Japanese exporters found their products suddenly 50% more expensive in international markets, without having changed a single element of how they designed or manufactured them. Export growth collapsed. Economic momentum that had been compounding for decades stalled almost overnight. The Japanese government and the Bank of Japan, genuinely terrified of recession, responded the way central banks almost always respond to an external shock of this magnitude. They eased monetary policy aggressively. Between January 1986 and February 1987, the Bank of Japan cut its benchmark discount rate in half, from 5% to 2.5%. The economy was flooded with cheap money to offset the damage the rising yen was causing to exports. The problem was that the cheap money did not go where the central bankers intended. Instead of financing productive economic activity that could compensate for lost export revenue, cheap credit poured into asset markets. Real estate prices in Tokyo and other major Japanese cities began inflating at a pace that had no rational foundation in economic fundamentals. Stock prices followed. The Nikkei index, Japan's equivalent of the Dow Jones Industrial Average, climbed from around 13,000 in 1985 to nearly 39,000 by the end of 1989, a tripling in just 4 years. Japanese property values reached levels so detached from economic reality that at the height of the bubble, the land beneath the Imperial Palace in Tokyo was theoretically valued at more than the entire state of California. This was not organic economic expansion. It was a credit bubble deliberately inflated by emergency monetary easing deployed to offset the consequences of the Plaza Accord's currency shock. And like every credit bubble in recorded history, it had a ceiling. In 1989 and 1990, the Bank of Japan raised interest rates 5 times in an attempt to cool the overheating asset markets. The Nikkei peaked at 38,915 on the final trading day of 1989. By August 1992, it had fallen to approximately 14,000, a collapse of more than 63% in under 3 years. Real estate prices followed, and they kept falling, not for a year, not for 3 years, but for 15 consecutive years from their 1991 peak. Japanese banks, which had used inflated property as collateral for the loans that funded the bubble, found themselves sitting on catastrophic losses. Rather than forcing a painful but rapid restructuring, writing down bad debts, letting insolvent institutions fail, clearing the system and allowing recovery, Japanese regulators allowed banks to carry non-performing loans on their books at fictional valuations. This created what economists now call zombie banks and zombie companies, businesses that were technically insolvent but kept alive by rolled-over debt, permanently blocking capital and resources from flowing toward productive new enterprises. The economy calcified. New growth could not emerge because the old failures were never cleared. The result was what historians and economists call the lost decade. Then 2 lost decades. Now, by most honest measures, 3. Japan's GDP in real terms in the early 2020s was barely larger than it had been in 1995. A country that was on a credible trajectory to overtake the United States as the world's largest economy in the early 1980s spent 40 years going essentially nowhere. The Nikkei index did not recover its 1989 peak until 2024, 35 years later. And the direct chain of causation runs from that recovery all the way back through the bubble, through the Bank of Japan's emergency rate cuts, through the export shock, to the room at the Plaza Hotel where 5 finance ministers decided to solve America's currency problem using Japan's exchange rate. Now let's bring this forward to the present, because this is where the historical parallel stops being merely instructive and starts being actively relevant. In November 2024, Stephen Moran, who would subsequently become chairman of the Council of Economic Advisors under President Trump, published a paper titled A User's Guide to Restructuring the Global Trading System. The paper's central argument was precise and unambiguous. The US dollar is chronically overvalued as a structural consequence of its global reserve currency status, and that overvaluation is the root cause of America's persistent trade deficits and the long-term hollowing out of American manufacturing. The proposed remedy was a coordinated international agreement to weaken the dollar, using tariffs and American security guarantees as leverage to bring trading partners to the negotiating table. The name that attached itself to this proposal almost immediately in financial and policy circles was the Mar-a-Lago Accord, a direct and deliberate reference to the Plaza Accord of 1985, replacing the Plaza Hotel in New York with Trump's estate in Florida as the symbolic venue of a new currency agreement. The parallel was not subtle. It was explicit by design from the people proposing it. Through 2025, several of the framework's core elements began moving from academic paper to implemented policy. Tariffs were imposed broadly and at scale, resetting trade relationships and creating negotiating leverage. Overseas allies were pressured to increase their own defense spending, reducing their dependence on the American security umbrella and giving Washington a tool to extract concessions. The dollar weakened approximately 9% on a trade-weighted basis through the course of 2025. The architecture described in Miron's paper was transitioning from theory toward active implementation. But there is a structural problem that sits at the center of the Mar-a-Lago framework, and it is the reason that many serious economists believe the 2026 version carries significantly more risk than the 1985 original. China has watched all of this extremely carefully, and China has explicitly stated, at the policy level, that it understands precisely what the Plaza Accord did to Japan. Beijing treats the Japanese experience after 1985 as the definitive cautionary example of what happens when a major economy allows the United States to dictate the value of its currency. Japan trusted the framework, accepted the yen appreciation, and spent 3 decades paying for it. China has made clear it has no intention of repeating that sequence. In 1985, every country that signed the Plaza Accord was, to varying degrees, dependent on American military protection. Japan hosted American bases. West Germany was defended by American troops against the Soviet threat. France and the United Kingdom were core NATO allies. The United States had genuine structural leverage. Today, the countries running the largest trade surpluses with the United States, China, Vietnam, Mexico, do not rely on the American security umbrella in the same way. The leverage architecture that made the original Plaza Accord possible does not exist in its 1985 form. This means that if the current administration wants to achieve the dollar weakening that is central to the Mar-a-Lago vision, it may ultimately have to pursue it unilaterally rather than through a negotiated accord. And a unilateral dollar devaluation, achieved through tariff shock, political pressure on the Federal Reserve, and sustained fiscal expansion, carries risks that the coordinated 1985 version simply did not. The dollar is not merely America's national currency. It is the global reserve currency. Approximately 58% of all foreign exchange reserves held by central banks around the world are denominated in dollars. The majority of global commodity trade, including oil, is priced in dollars. The U.S. Treasury market functions as the backbone of the global financial system precisely because foreign investors trust that the dollar will hold its value sufficiently to make holding dollar-denominated assets worthwhile. That trust has been built over 80 years. It is not unlimited, and it is not unconditional. When the administration signals that it wants a weaker dollar, when it applies political pressure on the Federal Reserve to reduce interest rates, and when it runs fiscal deficits that require trillions in new Treasury issuance each year, foreign holders of dollar assets run a straightforward calculation. Is the dollar I will be repaid with worth as much as the dollar I originally lent? When enough of those holders decide the answer is trending toward no, they sell treasuries. They diversify reserves into gold, into euros, into yen-denominated assets, into anything not directly exposed to deliberate American currency debasement. That selling pressure drives Treasury yields higher, which increases the cost of financing $36 trillion in federal debt, which creates precisely the fiscal crisis that a weaker dollar was supposed to help avoid. The trap closes on itself. There is a second risk that is even more direct. If the dollar weakens significantly, imports become more expensive for American consumers and businesses. More expensive imports mean higher inflation. Higher inflation means the Federal Reserve faces pressure to raise interest rates at the exact moment the administration wants rates lower. That is not a theoretical contradiction. That is the fundamental tension at the heart of the strategy. And it is structurally identical to the contradiction that broke Japan after 1985. The currency adjustment that was supposed to restore export competitiveness triggered monetary conditions that inflated a historic asset bubble, and the correction of that bubble cost Japan 3 decades of economic growth. So the question worth sitting with seriously is not whether the Mar-a-Lago Accord is happening. Parts of it are clearly already in motion. The dollar has weakened. Tariffs have been deployed as leverage. The policy architecture described in Miron's paper is being implemented in recognizable form. The question is who pays the price for the adjustment this time. In 1985, Japan paid. In 2026, with China explicitly refusing to play the role that Japan played, with the global financial architecture far more complex and interconnected than it was 40 years ago, and with the United States itself carrying debt levels that make it meaningfully more vulnerable to any erosion of foreign confidence, the answer to that question is genuinely less certain. And that uncertainty is exactly the kind of environment where understanding the historical pattern is not merely interesting. It is practically essential. For investors and observers trying to navigate what comes next, several things follow clearly from the historical analysis. Currency wars do not produce clean winners. The Plaza Accord achieved its narrow objective for the United States. It reduced the trade deficit through the early 1990s. But it also helped inflate Japan's asset bubble, and when that bubble burst, it created 3 decades of global deflationary pressure, a generation of zombie banking institutions, and a template for central bank dysfunction that influenced monetary policy worldwide for decades afterward. The ripple effects of that 1985 hotel room agreement are still shaping Japanese monetary policy today. Currency interventions of this scale are not surgical instruments. They are blunt forces with unpredictable second and third-order consequences that compound over time. In terms of what historically benefits during a deliberate dollar weakening cycle, gold, denominated in dollars, rises as the dollar falls, which is one reason why central banks globally have been accumulating gold at a pace exceeding 1,000 metric tons per year. Broad commodities, oil, copper, agricultural goods, reprice upward in dollar terms when the dollar weakens. Companies with significant international revenue and stronger currencies see overseas earnings translate back into more dollars. On the other side of the ledger, importers face cost compression. Bondholders who lent in dollars receive repayment in a currency worth less than when they lent, and long-duration treasury holders are doubly exposed to both currency debasement and the rate pressure that tends to accompany it. But perhaps the deepest lesson from Japan's experience is not about asset allocation. It is about what happens when central banks respond to an externally imposed currency shock with emergency monetary easing. The Bank of Japan did not intend to inflate a bubble. It was trying to offset genuine economic damage caused by a force it had not chosen and could not easily resist. The emergency rate cuts were rational within the logic of the moment. The bubble was an unintended consequence of that rational response. The 30-year stagnation was the unintended consequence of the bubble. The lesson is not simply to watch for currency manipulation. It is to watch what central banks around the world, in countries whose currencies are being pressured by a weakening dollar, do with their own monetary policy in response. The second-order effects of a sustained dollar weakening cycle are where the real, lasting damage tends to accumulate. That is true whether you are looking back at 1985 or forward at 2026. The Plaza Accord happened. The lost decades happened. The Mar-a-Lago Accord is being built in public, by name, by the economists and officials running American economic policy. The historical pattern is not hidden in academic archives. It is being announced by the people repeating it. The only question is whether enough people understand the history clearly enough to see what the pattern suggests about what comes next. That is worth thinking about carefully.